All right, welcome back everybody to another webinar here with Prime Ag. We're going to have two this week. We've got today's, we're going to cover re-ownership. And then on Friday, we have a USDA report out, and we'll do a wrap-up of the USDA numbers. So be sure to tune in or hit the subscribe button to get notified when we post those videos. But today, we are covering re-ownership, kind of part of additional coverage of our marketing 101 scenarios, if you will. So, re-ownership, what is it? Using the futures board to purchase contracts or replace contracts of sold physical bushels. It's for producers and end users. Today's examples will cover the producer side of things. And then is it a hedge or a spec? We would consider it kind of both. When you make those cash sales, you're hedging against futures prices falling. However, when you buy and re-own part of your bushels or all of your bushels, you're retransferring that risk over to the board side of things to maintain a presence of higher prices. So it's kind of a balancing act. We will use stop losses in here to keep the risk somewhat limited. So how do you re-own? And this, and as we go through today, we're going to talk about just buying futures. So that's a marginable position. Theoretically, you have unlimited risk, and you'll need to add margin if prices move against you. Further on, we'll show you about how much you'd need to budget for spring wheat in this example. And then using that stop loss to limit your risk. And then the gain or loss on the futures contract side of things will be added or subtracted to your physical grain price. And then keep in mind, basis, storage, commissions will all affect your final price. As we go through these examples, we are just referencing futures prices to keep everything simple. But again, keep in mind your basis, etc. Today we are covering spring wheat because those guys are wrapping up harvest. We feel this is pretty applicable to them. But if you're a corn and bean farmer, please stay tuned through the entire video. The whole point of this is to give you guys an idea, help you be a little bit proactive in your thinking as we head into corn and bean harvest here in the next couple of weeks as well. So here's our re-ownership example. We have a daily December spring wheat chart. Prices have been moving pretty well sideways here for the last month and a half, between 9 and 9.40. You kind of have a clear resistance level at 9.40, and we'd say support right now is about $9. In our mind, it's worth making these cash sales in this zone, and then we would target above 9.40 as a potential area to re-own. If you get a good close above that resistance zone, chart suggests you could see a nice run to 9.80, maybe $10. So again, we would plan to make these, in this example, plan to make these cash sales somewhere in here. And then if the market breaks higher, look to re-own some of those bushels. So let's say you have 50,000 bushels of spring wheat and you make your sales between 9 and 9.40. That's going to give you an average price of 9.20 futures. Okay, and then we say, why would you own a breakout above 9.40? Well, new highs obviously present an opportunity for the market to run. We cleared a resistance zone. Price could certainly be searching for that next resistance. Sellers are out of the market, things of that nature. We saw that in corn and beans last year. The farmer, who's a natural seller, got overextended basically to the short side. They sold out of physical bushels pretty early. Funds were able to run this market higher without much of a natural seller to step in. So that's kind of the mindset you have to think about and bring to the table as you're making your cash sales. But in the back of your mind, be prepared to re-own these things if there's a breakout above 9.40. That's really the move you want to be on board for. Now you might say to yourself, well, why don't I just wait for a breakout above 9.40 to make my cash sales? Well, there is no guarantee that we are going to get above 9.40. Perhaps 9 doesn't hold anymore support, and now we're down at 8.50. So that's where, again, this is a highlight of flexibility in making your cash sales and then considering coming back to the board to re-own some of it to, again, maintain that presence in the market. So how are you going to define your risk? For one way to do it here is using ATR. That's the average true range. Right here, we're using a 10-day. So basically what the futures price is likely to move in a day over the last 10 days. So right now for spring wheat, it's 11 cents. A lot of times we'll use a multiple of the ATR. In this example, we'll use 1.5 times the ATR. It gives you about 16.5% or 16.5 cents worth of risk. So on our 9.40 minus 16.5 cents of risk gives you a stop loss at 9.23.5. For us, that's good enough. It tells us that we were not correct in this breakout. We gave it some room, but obviously we were wrong, and we're not going to sit here and hold the bag if this market is going to continue to erode. So let's take a look at what happens if you are buying this breakout and you are right, okay? Same 50,000 bushels sold. We get it done for an average price of $9.20. We buy that $9.40 breakout and market goes to $10, okay? You've got a gain of 60 cents on your futures, about $15,000, bringing your net price to all your bushels up to $9.50. Nice little way to add, to stay on board and to raise up your your overall net price. That 16.5 cents represents about a 1.8% risk of your 9.20 average sale. If we get a 60-cent return, you're looking at about a 6.5% return on your average 9.20 sale. So almost a 4-to-1 risk to reward ratio on that in that scenario, which we find to be pretty good. We pointed out here we're not factoring in commissions. In our case, if you figure about a penny per contract. 5 contracts, you're looking at about a nickel. So your net gain on futures might be 55 cents after you factor in commissions. Definitely worth it. Now, what if the market goes against you? Let's say you buy that breakout above 9.40 and it turns out to be a false breakout and the market comes down. Again, you had that stop loss in place. We decided to risk that 16.5 cents, which comes out to about $4,125. That's going to bring your net price down on all your bushels to 9.11 3/4. So again, you're risking about 1.8% of your average sale. You have to decide if that's good enough for you or not to be on board. I think it's personally, I think it's worth the the risk as we go through this example. No breakout above 9.40. Well, you get to look at this as you made cash sales near the top of the market. Let's say you again use 9 to 9.40. You make your sales in there, 5 sales or 10 sales in there, come out to an average around 9.20. And you call it good. The reason why we're using this 9.40 is it kind of works as a filter. If the market doesn't get above 9.40, to us, there's really not much point in re-owning to try and catch an extra nickel or dime. We want to be on board for the big move higher. That's the point of re-owning. So we're willing to risk and test a move above 9.40 on a breakout that we hope to see $10, maybe higher. Rather than trying to re-own at, say, 9.10 or 9.20 and chase a nickel or a dime around the market. It just doesn't make a whole lot of sense to us. So again, risk to reward is really kind of the key in here, and the flexibility. Quick touch on margin. Okay, it's the cash outlay to hold your contract on the futures board. For spring wheat right now, initial margin's $3,315. Compare that with the cost of a full contract, $42,250 at $9. So again, leverage contract, but I would say it's a pretty good deal being able to buy and hold a spring wheat contract for $3,300 rather than $42,000 as far as the cash position goes. So again, if the market goes against you a penny, you're going to need to deposit additional margin in your account. But as we stated, we're going to use a stop loss. We're figuring about 16.5 cents, which comes out to $8.25 a contract. So as you see below, you budget your initial margin of $33.15, add your $8.25. That brings you to about $4,140 per contract. This fixes your risk in most cases. Why I say most cases is the market could gap around your stop. Is it likely? No. Does it happen? Yes. Should it make you afraid of doing this? No. And the point here, though, is that you can calculate how much cash you're going to outlay for this position and how much you're willing to risk. This is a lot different from guys that we hear from their experiences. They get into these things, they re-own and they hold this thing all the way down. What we feel is best is you need to make a clear, decisive stop loss area. And if it goes below that, you just need to accept the fact that you were wrong on this position. It doesn't make you a bad person. It doesn't make you dumb. It just means that the market did not go in your favor at this time. And you don't need to be holding the bag all the way down to 9 or 8.50 or whatever and watching your futures price erode. So final thoughts in here. The whole point of this is just to highlight that the re-ownership does provide flexibility in marketing. Again, spring wheat producers, this is something that you could be looking at right now with harvest going on. Corn and bean guys, this is something you need to be thinking about as we get into harvest. If you have made your cash sales and you start to see the market going higher, keep in mind what levels you might want to look to re-own if this is something that's going to fit your risk tolerance. Key points: have a plan, call us. That's what we're here for. Again, we can find some support, some resistance areas. We can help you calculate what you're willing to risk as far as stop losses go. And then again, kind of a personal question for yourself. Do you want to hold your risk in physical bushels? Or would you rather make the cash sale knowing what the market is giving you now, and then have a targeted area to re-own that if the market is going to run, you have the potential to be on board? Again, at the bottom, we already kind of talked about this as far as what can I live with. If you're a guy that can deal with the finality of cash sales, and if you're sold out of, let's say, spring wheat and the market goes higher and you're just going to sell some of next year's wheat, that's fine. If you're a guy that can't handle that, what you need to consider then is looking at, like I said, areas of resistance to consider buying breakouts if the market is going to move higher. I think that some of the best guys out there that are marketing are willing to be flexible. You don't need to do all of your bushels. Again, this is a risk management, risk tolerance type of scenario. But even going back, we now have the benefit, of course, of hindsight on corn and beans. We struggled with guys to I remember having conversations with guys about corn getting back to 380. Guys didn't think it could get there. Hard pressed to get them to re-own once corn got past 380. But again, you kind of need to think about and have this in the back of your mind. At which point are you willing to re-own the board if you make cash sales? And then, like I said, finally, use a stop loss. Keep your risk fixed so that your net prices are overall protected. But if you guys have questions, feel free to email us, admin@prime-ag.net. We'll have that down in the description below. Be sure to like this video if you found it helpful. And then, again, we'll have another one out here on Friday after the USDA report. So subscribe to our channel if you want to be notified for when those videos come out. And, we appreciate you guys tuning in. Like I said, feel free to email us or call us if you have any questions. Part of our service here as brokers is to put these things out and to work with guys on finding re-ownership areas. So again, if this is something that you would like more information on, if you need help with, if you need somebody to watch these positions, this is what we're here for. So give us a call. But otherwise, we will see everybody again on Friday. Thanks.